The global oil market has always been surrounded by myths of endless stability and permanent growth. For Russia, this sector was not just an economic foundation, but a carefully built narrative of strength and independence. Yet according to our sources, that narrative is now showing dangerous cracks. In expert circles, the phrase oil crisis is no longer whispered as a distant threat, it is cautiously pronounced as a reality unfolding step by step inside the Russian economy. Official statements emphasize resilience, self-sufficiency, and adaptation to new circumstances. But behind the scenes, calculations tell another story. Revenues are shrinking, reserves are being tapped more often, and decisions that once appeared strategic now look like improvised reactions to accelerating pressure. Observers note that the shift is not sudden, it is a gradual accumulation of shocks that together form a new picture. Sanctions, logistical costs, technological restrictions, and changing global demand all intersect at a moment when Russia's reliance on oil exports is at its peak. Analysts underline that this intersection is what creates the fragility. Any one factor alone could be absorbed, but their combination generates systemic strain. In recent months, trading data has revealed a pattern that officials rarely acknowledge. Discounts on Russian crude, offered to secure buyers in Asia, have widened significantly. These discounts, sometimes reaching double digits compared to global benchmarks, mean that even when oil prices appear stable on world markets, the Russian budget receives far less per barrel than headlines suggest. Sources close to trading companies describe increasingly tough negotiations. Buyers in India and China, aware of Moscow's limited alternatives, press for favorable terms and extended credit. Meanwhile, shipping routes that bypass European restrictions add complexity and expense. Longer voyages, shadow fleets, and high insurance premiums become part of everyday operations. Each of these hidden costs chips away at net revenue. Insiders at financial ministries calculate that the actual profit margin has been reduced so sharply that planned spending commitments are no longer fully covered. Behind closed doors, officials debate whether to cut programs, raise taxes, or rely more heavily on reserves. None of these options is politically simple, yet all are becoming unavoidable. The oil sector was once described as Russia's budgetary shield, protecting against turbulence. Now, according to specialists we consulted, it looks more like a liability. Fields developed decades ago are declining in productivity, while new fields require advanced technology that has become harder to import. The absence of modern drilling and recovery equipment gradually lowers output efficiency. Some industry experts project that in 5 years, without technological renewal, production could fall to levels not seen since the turbulent 1990s. Officials reject these forecasts publicly, but our sources confirm that internal reports echo similar concerns. The paradox is clear: Moscow speaks of diversification and energy strength, while behind closed doors it fears stagnation and decline. This duality explains the careful tone of official briefings: optimism in public, worry in private. It is not only about economics but about legitimacy. Energy revenue funds not just the state budget but also the political narrative of stability. If that foundation weakens, other pillars begin to look less secure. The international environment intensifies these vulnerabilities. Demand in Europe, once the largest market for Russian energy, has collapsed almost entirely. Replacement markets in Asia absorb some of the output, but not on equal terms. Meanwhile, global shifts accelerate. Renewable energy, electrification of transport, and efficiency improvements steadily limit long-term demand growth. Observers point out that the golden era of oil, where prices rose with each cycle, may be fading. For Russia, this is particularly dangerous, because unlike more diversified economies, it remains highly dependent on energy exports. Every fluctuation in global prices directly influences the budget. And when combined with discounts, logistical costs, and sanctions, the vulnerability becomes structural. According to conversations in expert communities, this is why the term crisis is used, not because of a single collapse, but because of a systemic exposure that erodes resilience over time. The population already feels indirect consequences. Inflation, currency fluctuations, and regional budget shortfalls create daily pressure. Local administrations struggle to finance infrastructure and social services. Business owners complain quietly about unpredictability. One week transport costs surge, the next week supply contracts are disrupted. All of this, they say, can be traced back to instability in the oil sector, even if official channels insist on external causes. Sociologists note a gradual shift in public mood, not dramatic, but subtle, expressed in rising skepticism toward official reassurances. Trust, once reinforced by energy finance prosperity, now weakens at the margins. This erosion may seem minor today, but experts warn it can accumulate silently, shaping the political environment in ways not yet fully recognized. Behind the walls of Moscow's ministries, discussions grow sharper. Reserve funds, once abundant, are now viewed as strategic lifelines. Questions arise: how long can they cover deficits? How much pressure can be shifted onto domestic companies without triggering resistance? How much longer can official optimism mask real vulnerabilities? None of these questions have easy answers. Observers underline that when officials debate such points in private, it means the situation is already more serious than public discourse allows. It is within this atmosphere of hidden anxiety that the phrase oil crisis acquires its full meaning. It is not about spectacular collapse but about the slow realization that the model which once guaranteed stability now generates uncertainty. For those who want to keep following these subtle but decisive shifts in Russia's political economy, subscribing will ensure you stay informed as the story unfolds beyond official headlines. In confidential conversations among financial officials, the scale of the budgetary challenge becomes clearer. Russia's federal budget has long depended on oil and gas revenues to cover a substantial portion of expenditures. According to our sources, nearly half of the budgetary inflows are still tied, directly or indirectly, to the energy sector. When global demand weakens or export routes face complications, this dependency turns from advantage to vulnerability. Experts explain that Moscow has attempted to adjust by raising non-oil taxes, issuing domestic bonds, and using the National Wealth Fund. Yet these measures are temporary buffers rather than long-term solutions. The underlying dependence remains intact, and as insiders quietly admit, it is becoming increasingly difficult to conceal structural gaps. Behind closed doors, ministries calculate scenarios that once seemed theoretical, budget deficits lasting not 1 or 2 years but potentially stretching across a decade, unless a new revenue model emerges. The mechanics of these shortfalls are visible in daily operations. For example, regional administrations complain of delayed transfers from the federal center. Projects announced with fanfare stall due to lack of financing. Contractors are instructed to wait for payments, while essential services quietly downgrade standards. A governor from a central region, speaking off the record, described it bluntly: "We are told to maintain stability, but the resources we need arrive late or not at all." Such testimonies rarely appear in official media but circulate in private circles, reinforcing the perception that the system is stretched thin. The Kremlin responds with visible caution, carefully avoiding words that might hint at austerity. Instead, it frames delays as technical adjustments or reallocations. But within expert communities, the consensus is emerging: the oil-financed stability of the past cannot be maintained under current conditions. The logistics of oil exports illustrate the problem vividly. Traditional pipelines leading to Europe now function at a fraction of their former capacity. To replace them, tankers sail thousands of kilometers to Asian and Middle Eastern ports. Each voyage requires insurance, refueling, and often cooperation with shadow intermediaries who disguise the cargo's origin. These intermediaries charge high fees, eroding profits further. According to shipping industry insiders, the number of vessels engaged in these shadow operations has increased sharply, but so have accidents, delays, and disputes. Some tankers reportedly wait weeks at ports due to paperwork complications or sanction-related inspections. For Moscow, this means cash flows are interrupted. The image of oil as a steady, uninterrupted source of money no longer holds. Instead, it resembles a fragile chain in which every link is vulnerable to disruption. Technology restrictions deepen the crisis. Modern oil fields, especially those in harsh climates such as the Arctic, require sophisticated drilling equipment, software, and maintenance services. Sanctions have effectively blocked access to much of this technology. Russian engineers attempt to substitute with domestic alternatives, but insiders admit that progress is slow. In some cases, spare parts are cannibalized from existing equipment; in others, operations are scaled down. The result is not a sudden collapse but a gradual erosion of efficiency. Productivity declines year by year, unnoticed by the general public but painfully clear in industry reports. Observers point out that oil extraction is not a sector that tolerates improvisation for long. What works for one season may fail entirely after several. Thus, the absence of technology today plants the seeds of deeper decline tomorrow. Financial analysts warn of another hidden danger: the growing reliance on debt. With revenues under strain, the state issues more domestic bonds to cover expenditures. Banks, often pressured by regulators, purchase these bonds, effectively recycling savings into government spending. While this provides short-term liquidity, it concentrates risks within the financial system. Should revenues continue to fall, the state may face increasing difficulty rolling over debt without resorting to inflationary financing. Insiders in the financial sector compare this to borrowing from the future, a strategy sustainable only if circumstances improve. Yet with oil revenues under pressure, improvement appears unlikely. This dynamic, experts note, resembles patterns seen in other resource-dependent states during times of stress, short-term stability at the cost of long-term fragility. The social implications cannot be ignored. Rising costs of imported goods, combined with stagnant wages, create quiet discontent. Official statistics emphasize stability, but sociologists highlight an increase in household borrowing and reliance on informal economies. Small businesses complain of unpredictable regulations and sudden tax demands. In private conversations, entrepreneurs connect these difficulties to the broader uncertainty of the oil sector. When revenue from exports falters, the state compensates by extracting more domestically, often at the expense of private initiative. This cycle, repeated over months and years, fosters an atmosphere of caution and resignation. People adapt by lowering expectations, delaying investments, or seeking opportunities abroad. The outward calm hides an undercurrent of unease. Diplomatically, the oil crisis reshapes Moscow's bargaining position. Energy has long been a central tool of foreign policy, used to secure influence over neighbors and partners. Yet when revenues decline and discounts become necessary, leverage weakens. Countries that once accepted Moscow's terms now negotiate harder, aware of its limited options. According to diplomatic insiders, this has led to subtle but noticeable shifts in conversations with partners in Asia, Africa, and the Middle East. Russia remains an important supplier, but no longer dictates conditions with the same authority. This erosion of influence is gradual, yet significant. As one foreign observer noted, when your main export becomes a discount commodity, your bargaining power diminishes proportionally. In expert circles, the consensus is that Russia's oil sector faces not a temporary fluctuation but a structural transformation. The pillars of demand, technology, and logistics are all under strain. While the Kremlin insists on resilience, insiders acknowledge that resilience today means survival, not growth. The real question is how long this survival can be maintained before deeper reforms are unavoidable. Those reforms, however, would require political choices that the current leadership seems unwilling to make. And so the cycle of improvisation continues, patching immediate holes while long-term cracks widen quietly in the background. The crisis is not confined to oil wells and export routes, it extends deep into the political system itself. Insiders in Moscow describe a growing tension between the need to present strength and the reality of limited options. The government is under pressure to maintain ambitious spending commitments, financing military operations, sustaining social programs, and supporting infrastructure projects. Yet as revenue narrows, choices become more difficult. According to sources in the financial sector, ministries are quietly ordered to optimize budgets, a word that in practice means cutting non-essential programs and delaying payments. At the same time, taxes on energy companies are being raised to capture as much revenue as possible. Executives complain in private that they are being squeezed from both sides, asked to maintain production under sanctions while transferring larger portions of profit to the state. This, they say, erodes investment capacity and accelerates decline. The leadership insists publicly that the system is stable, but internally it acknowledges the burden is unsustainable. The cracks are also visible in the currency market. The ruble has come under repeated pressure, with central bank interventions required to stabilize exchange rates. Officials attribute volatility to external shocks, but analysts underline that the root cause lies in shrinking oil revenues. When fewer dollars and euros flow into the system, the currency loses its anchor. This depreciation feeds inflation, raising the cost of imports and eroding household purchasing power. To counter this, the central bank raises interest rates, but higher borrowing costs in turn slow domestic investment. Thus, what begins as an oil revenue shortfall cascades into multiple sectors of the economy. According to our sources, even within government circles there is recognition of this chain reaction. The phrase used internally is secondary shocks, effects that multiply far beyond the original problem. Ordinary citizens notice these changes in subtle but significant ways. Prices for goods rise faster than wages. Regional authorities cut back on cultural programs, healthcare spending, or road maintenance. Businesses adapt by reducing staff or shifting to part-time arrangements. For now, these adjustments are gradual, avoiding outright crisis. Yet observers stress that the erosion of living standards is steady and difficult to reverse. Social scientists warn that prolonged stagnation creates frustration even without dramatic economic collapse. In conversations held privately, people express skepticism toward official reassurances. The confidence once derived from energy-driven prosperity has weakened. This psychological shift matters. It shapes how society interprets each new development, each fluctuation in the economy, each political message. International markets add another layer of complexity. Traders in global hubs like Singapore, London, and Dubai closely monitor Russian oil flows. Each report of discounts or disruptions triggers immediate adjustments in futures markets. This volatility benefits some speculators but creates uncertainty for long-term planning. For Russia, it means that even when barrels are sold, they no longer guarantee predictable revenue. Insiders point out that stability is just as important as price, and stability has become elusive. With every drone strike, sanction adjustment, or shipping complication, the perception of risk grows. And as perception shifts, buyers demand even larger discounts to compensate. What emerges is a cycle in which Russia must sell more oil for less money, a trap that undermines the very foundation of its budgetary model. Diplomatic leverage also weakens. For decades, energy was a cornerstone of Moscow's influence abroad. By promising supply or threatening disruption, it shaped policies in neighboring states and beyond. Today, with revenues falling and bargaining power diminished, that influence erodes. Conversations in international policy circles reflect this change. Partners who once treated Moscow as an indispensable supplier now see it as one of several options. They exploit Russia's need for markets to secure favorable terms. As one Middle Eastern diplomat commented privately, when a supplier has fewer choices, the buyers hold the advantage. This shift is subtle but decisive. Influence built on energy requires strength, not vulnerability. The longer this dynamic continues, the greater the strain on the political system at home. Energy wealth once financed loyalty, pensions, salaries, subsidies, and regional projects created a sense of shared stability. If that foundation crumbles, the state must find new ways to preserve legitimacy. Observers suggest that this explains the increasingly insistent narrative of resilience promoted by official media. By repeating assurances of strength, authorities attempt to counterbalance the reality of strain. Yet in expert communities, there is agreement that narrative alone cannot replace revenue. At some point, material shortages translate into political costs. The timing of that translation remains uncertain, but its inevitability is widely acknowledged. Analysts stress that the true risk of the oil crisis is not a sudden collapse but a gradual erosion of pillars that once seemed unshakable. Budgetary gaps widen, technological deficits accumulate, logistical costs grow, and social trust weakens. Each of these on its own may be survivable. Together, they form a pattern that insiders now describe as systemic fragility. This phrase, used in confidential reports, captures the essence of the problem. The system appears intact on the surface, but underneath, pressure builds in multiple directions simultaneously. The outcome may not be dramatic headlines but rather a slow decline that reshapes the entire model of governance and economy. Observers underline that these transformations are rarely visible in daily news but become undeniable in retrospect. Today, the signals are already there for those willing to look closely. And if you want to continue receiving perspectives that connect these hidden signals into a broader picture of global finance and politics, subscribing will keep you ahead of the narrative that official channels prefer to present. The international context continues to magnify the challenges facing Russia's oil sector. Observers note that global demand patterns are shifting in ways that no producer can ignore. China, long regarded as the most reliable engine of consumption, is now demonstrating slower growth. Its domestic policies increasingly favor renewable energy and electric transport, gradually reducing reliance on imported oil. Meanwhile, Europe, once Russia's primary customer, is accelerating diversification away from fossil fuels altogether. Even in regions like South Asia and the Middle East, where demand still grows, competition has intensified. Producers from the Gulf, Latin America, and Africa all vie for the same markets, often offering better logistics, fewer political risks, and more favorable financing arrangements. In this environment, Moscow's traditional advantage as a stable supplier is no longer sufficient. Buyers demand deeper discounts, more flexible contracts, and political concessions. As a result, each sale secures revenue, but at a shrinking margin. Analysts describe the situation not as a temporary setback but as a structural shift in the balance of energy markets. These changes are already influencing financial indicators. Oil price benchmarks remain volatile, but the key metric for Moscow is not the global price but the differential applied to its own exports. According to traders, this differential has widened to levels that undermine profitability. Transport costs add another burden. Rerouted shipments to Asia increase expenses significantly compared to pipeline exports to Europe. Insiders reveal that some voyages cost nearly twice as much as before, once insurance, intermediaries, and extended routes are factored in. As a result, the net price Russia receives is far lower than the headline figures suggest. The state budget, tied to official assumptions of higher revenues, faces increasing shortfalls. This creates a gap between projections and reality that grows wider each quarter. Behind closed doors, officials attempt to revise expectations without admitting publicly that the assumptions were unrealistic from the start. Technology remains another point of strain. Extraction from mature fields declines steadily without constant investment and innovation. With access to Western technologies restricted, companies struggle to maintain output at historic levels. Attempts to replace advanced equipment with domestic alternatives face technical and financial obstacles. Insiders from the industry speak of patchwork solutions, improvisations that allow operations to continue but at reduced efficiency. In the short term, these measures prevent dramatic drops in output. In the long term, they create cumulative inefficiencies that erode competitiveness. Experts stress that oil is a sector in which time delays matter. Problems not solved today return magnified tomorrow. For Russia, the danger is that by the time alternative technologies are developed domestically, global demand may have shifted even further away from fossil fuels, leaving diminished returns for late investments. Regional economies within Russia illustrate the uneven consequences of this crisis. Areas traditionally dependent on oil revenue experience both budgetary strain and social tension. Local governments, reliant on federal transfers, report difficulties in maintaining healthcare systems, infrastructure projects, and subsidies. Delays in funding force cutbacks, which in turn erode public trust. Observers underline that these are not dramatic collapses but subtle degradations in quality of life. Roads remain unrepaired longer, salaries arrive later, equipment in hospitals is replaced less frequently. Citizens adapt, but frustration builds quietly. For regional elites, the dilemma is acute. They must maintain loyalty to Moscow while addressing local grievances with limited resources. This tension, insiders say, is rarely discussed openly but weighs heavily on the political system. Internationally, Russia's bargaining power is visibly shifting. Once able to dictate terms to buyers by leveraging energy dependence, Moscow now faces the reverse dynamic. Countries in Asia, Africa, and even Latin America negotiate with confidence, aware of Russia's limited options. Some secure favorable payment terms, others demand investments or political concessions in exchange for continued cooperation. Diplomats note that this represents a reversal of decades-long patterns, where energy served as Moscow's strongest card. The erosion of that card does not mean immediate isolation, but it narrows the scope of maneuver. Policymakers accustomed to shaping alliances with oil and gas revenues must adapt to a landscape where those revenues are shrinking. Analysts suggest that this adjustment will not be swift or painless, as it requires rethinking strategies that have defined Russian foreign policy for generations. The broader economic consequences of the oil crisis manifest in subtle but telling ways. Inflation, though managed publicly by central bank measures, is felt acutely in everyday life. Currency volatility undermines long-term planning for businesses and households alike. Credit becomes more expensive, discouraging investment. Young professionals increasingly look for opportunities abroad, perceiving limited prospects in a stagnating economy. While official statistics emphasize resilience, the lived reality tells a different story. Observers stress that this divergence between narrative and experience creates a credibility gap. When citizens repeatedly hear assurances of strength while confronting rising costs and shrinking opportunities, skepticism deepens. That skepticism may not yet translate into open dissent, but it reshapes the underlying social contract. Trust, once reinforced by energy wealth, now requires new foundations that have not yet been articulated. What makes the situation particularly complex is the slow pace of change. There are no sudden collapses, no spectacular breakdowns. Instead, there is a gradual erosion of revenue, of trust, of leverage. This erosion is harder to confront because it unfolds quietly, often masked by short-term fixes. Officials rely on reserve funds, impose new taxes, or shift resources between regions. These measures buy time but do not alter the structural trajectory. According to insiders, even within government circles there is recognition that the oil sector cannot sustain the system indefinitely under current conditions. Yet admitting this openly would undermine the very narrative of stability on which political authority rests. Thus, the crisis deepens in silence, its full dimensions visible only to those willing to look beyond official statements. Looking ahead, analysts present divergent scenarios, each with serious implications. In one version, Russia succeeds in stabilizing its energy flows, finding new buyers and continuing to finance the state budget despite shrinking margins. This path, however, depends on a delicate balance, maintaining sufficient production levels without access to advanced technology, navigating sanctions without triggering further restrictions, and persuading foreign partners to commit to long-term purchases despite market uncertainty. Experts underline that this scenario is possible but increasingly unlikely. Each condition is fragile, and the failure of one can unravel the entire structure. The alternative scenario, spoken of more frequently in expert discussions, involves a gradual slide into chronic deficits. Revenues fall short of expectations year after year, reserves are depleted, and the government resorts to borrowing and inflationary financing to cover obligations. In this trajectory, the oil sector does not collapse but erodes quietly, dragging the broader economy with it. The political consequences of such erosion are profound. Oil revenue has long served not only as the backbone of the budget but also as the foundation of political legitimacy. Subsidies, pensions, salaries, and infrastructure projects were financed by energy wealth. If this wealth diminishes, the state must either reduce commitments or find alternative sources of income. Both options carry risks. Reducing spending undermines social stability, while extracting more from domestic companies or citizens risks stifling economic activity and generating quiet resistance. Observers note that this is why official rhetoric emphasizes resilience and continuity. To admit fragility is to admit vulnerability in the very heart of the system. Yet insiders quietly acknowledge that choices can no longer be postponed indefinitely. The current model, built on abundant oil revenue, is no longer sustainable under the pressures of sanctions, logistical costs, and global transitions. Internationally, the shift reshapes Russia's position in the world order. For decades, energy was the lever through which Moscow exerted influence. European states, dependent on gas and oil, tailored policies to maintain supply. Developing countries, eager for partnerships, accepted Moscow's terms in exchange for access to resources. That leverage now weakens. Discounts, logistical delays, and reputational risks diminish Russia's ability to dictate conditions. Partners who once treated Moscow as indispensable now consider it one supplier among many. This erosion of influence may not be visible in daily news, but in long-term diplomacy, it changes calculations profoundly. Analysts stress that this loss of leverage will reverberate across foreign policy, limiting Russia's ability to shape alliances, negotiate from strength, or use energy as a political tool. The oil crisis is therefore not merely an economic issue but a geopolitical transformation. Domestically, the slow-motion nature of the crisis may create the illusion of stability. Salaries are still paid, energy continues to flow, and reserves cushion immediate shocks. But experts warn that this illusion is deceptive. Structural weaknesses accumulate, even if they do not erupt suddenly. Fields lose productivity, revenues shrink, reserves deplete, and trust erodes. The danger lies not in a single dramatic event but in the steady decline of multiple pillars at once. Observers describe this as erosion without collapse, a process that reshapes systems quietly until they no longer resemble their former selves. Citizens, meanwhile, adapt pragmatically, lowering expectations and adjusting to reduced opportunities. Businesses scale back ambitions, focusing on survival rather than growth. In such an environment, innovation slows, migration increases, and long-term development suffers. The overall effect is a slow contraction of possibilities, even if official narratives continue to emphasize continuity. For Ukraine, Europe, and other regions engaged in the broader geopolitical struggle, the Russian oil crisis carries strategic implications. It suggests that time itself may act as a force of change. While sanctions, military operations, and diplomatic negotiations continue, the structural erosion of Russia's energy sector works in the background, steadily undermining the foundation of its power. Analysts caution that this does not mean sudden collapse or immediate political change. Instead, it means that the long-term trajectory is downward, with fewer resources, less influence, and diminished resilience. For the global energy market, this represents both risk and opportunity. Risk, because supply disruptions remain possible. Opportunity, because alternative producers may expand their role. The balance of power in global energy, once tilted heavily toward Moscow, may gradually shift elsewhere. In the end, the oil crisis in Russia is not simply about economics. It is about the sustainability of an entire system built on energy wealth. It is about whether a state can adapt when the resource that guaranteed its stability becomes its vulnerability. It is about the choices leaders make when forced to choose between short-term survival and long-term transformation. Our sources and expert discussions suggest that these choices are already being debated behind closed doors, even if they are not admitted in public. For now, the official line remains one of confidence. But as one insider quietly observed, confidence does not refill reserves. It is this gap, between the narrative of strength and the reality of strain, that defines the current moment. And if you want to follow how this gap evolves, how it shapes not only Russia's economy but also the global order, we encourage you to stay with us and subscribe, so you don't miss the developments that may determine the next decade.